So
This meeting
wish
is
you
being
all
recorded.
wish you all a very good evening. The speakers for today's session, CA Shabbir Motorwala and Shri H S Mohanty sir. The chairman of the Ahmedabad branch, CA Harit Dharewal. The coordinators for today's session, CA Soumya Sheth and CA Hardik Mehta, and friends and participants. Wish you all a very good evening and welcome to the most awaited session, the Brain Trust session of the FEMA workshop. Before we start, please join us for the ICI motto.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्वैता 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 एतद्वैता.
So, good evening and welcome to today's session. We have two very learned speakers with us, Shri H S Mohanty and CA Shabbir Motorwala with us for the Brain Trust session today. Shabbir Bhai and Mohanty sir, what we for the benefit of the participants, what we will do is we will share the screen for the questions, and the questions
yes.
will be read out to you, which you can answer. So if that is fine with you?
That is perfectly fine.
Excellent. So now we are in for a great session. And before we start the session, I would now like to request CA Hardik Mehta to introduce both our learned speakers for today.
Ma'am, thank you. I'll just like to interrupt. I would also like to say
sorry.
words before I hand over.
You.
I would not like to miss this opportunity. I think since it's the last session of FEMA series, and we have had wonderful, I think 1.5 months with all the faculties. So my sincere thanks, first of all, to all the faculties, Shabbir Bhai, Mohanty sir, and all the other faculties who have had such a wonderful deliberation in the last 1.5 months. Members are very happy. Sir, they are even watching the recordings. And I'm sure even today's session is after being recorded, members are going to watch it on the YouTube. My sincere thanks to Soumya and Manisha Ben. I think they are the two pillars of this conference, of this entire series. It was not easy. Believe me, 50 hours FEMA series has never been done before. And thanks to Soumya and Manisha Ben for keeping it so inclusive. All the topics were there. All the faculties were the experts in their field. And especially, coordinating with the faculties and with the participants. So hats off to both of you. I think we did it finally. I think a long awaited thing. So thanks to you. My thanks to all the participants. Of course, I think more than 500 participants are there in this series. They were joining in today, but they are watching all the series on the YouTube. So thanks to all the participants from across the country, those who have joined us for the FEMA series. And yes, I now since it is live, I will also like to mention to all of you that we are very happy to announce that Ahmedabad branch has won all the 4 awards. 2 awards at the national level for the best branch for members and students, and even at the WRC regional level, we have got the best branch. So we are very happy at Ahmedabad branch. Thanks to all the members and students for their support. And once again, thanks to all the faculties for joining in today. Shabbir sir and Mohanty sir, I think your experience and your guidance will definitely help all the members. I think the Swami has prepared some very good questions. So I'm sure we are going to have some very interesting session lined up. Thank you so much.
Thank you, Chairman, sir, I'm sorry I bumped you out. I missed you out. Over to you, over to you, Hardik, now for the introduction. Hardik? Sorry,
I think
over to you, Soumya, for the introduction.
sure. So I'll just give a brief introduction. Thank you, Harit, and thank you, Manisha Ben. At the outset, thank you, Mohanty sir and Shabbir bhai for this session. It was long awaited, believe me, sir. Everyone was eagerly awaiting for this session. We had to reschedule it for a variety of reasons. But at the end, most of the people, this is one session which everyone was awaited with bated breath. Now, to the kind task on hand for the introduction, we have one of the most learned professionals before us to guide us through the intricacies of FEMA today. First and foremost, Mr. Mohanty sir. Mr. Mohanty sir has an enormous experience. He is practicing in the field of foreign exchange since 1982. That is the year before I was born, or before most of us were even born. So in that sense, sir's experience in this field, crossing more than 4 decades, is tremendous, and he has spent most of his time working in RBI, handling all its divisions, including currency management, regulation of financial markets, government banking, etc. He was a key person who was responsible for the transition from the erstwhile FERA regime to FEMA regime. So if anyone is the person to guide us that what is the difference between FERA and FEMA, and what was the logic behind the introduction of FEMA, and how do we interpret or how do we go about in FEMA, Mohanty sir is the best person on this planet to guide us through that, because he has been in the forefront since 1999-2000, and he was involved in the liberalization and rationalization of the framework. From 2006 to 2013, he was also part of RBI's monetary policy and exchange rate implementation, and he dealt with very closely in the area of post-Lehman Brothers during the 2006 set and as well as in 2013. So he is absolutely hands-on in the field of foreign exchange, and I'm sure there is no question which anyone on this planet, which I would say Mohanty sir may is unable to answer, because I am sure that for each and every question he has satisfactory answers, and he is the go-to person to guide us in the field of FEMA. As far as his academics are concerned, he did his master's in economics from the very distinguished Delhi School of Economics, and is also a certified associate of Indian Institute of Bankers. He is also visiting fellow in the University of California during 2005-06, and has also worked in the fields of financial market institutions and risk management. With this, sir, kind introduction, we welcome you to the Ahmedabad branch, and we look forward to many further such interactions, hopefully live, sir, in person, and it will be a great pleasure to meet you in person and to hear from you in person. Welcome to Ahmedabad branch, sir.
Thank you so much.
The next speaker for today, the next speaker for today, Shabbir Motorwala, sir, is a partner of BSR and Company, practicing in the field of international tax, FEMA, and regulatory practice. He has more than 25 years of experience and is with this from BSR and Company for more than 21 years. The main focus area of sir is because he is the person who has guided each and everyone who has trained below him to be the field, to be expert in their specific field, be it FEMA, or be it regulatory tax or corporate tax. I had started my career with the blessings of Shabbir bhai, and with his blessings, whatever I am today is all due to his sincere devotion and his sincere teaching. So, and without any doubt, as far as FEMA is concerned, if there are any specific points, any specific issues, he is one of the very good professionals and one of the best professionals, I would say, in the consulting world, who can guide you in the field of FEMA. And he has tremendous experience with practicing in the field of FEMA, regular speaker at various forums, ICI, BCS, CTC, and he is also a regular contributor to various articles. And believe me, all his articles are so well researched that if anyone does not have any idea on FEMA or any other topic, once he reads that article, he is absolutely clear, and he becomes a master of that topic. That is the kind of training which sir provides. So welcome you, sir, for the Ahmedabad branch for this session. All of us are looking forward to your valuable inputs, and we look forward to a very interesting and most awaited session of Ahmedabad branch since past 6 months. Over to you. Thank you.
Thank you very much, Soumya, for the wonderful introduction of both these wonderful speakers. All of us are like geared up and we are hold our breath for such a wonderful session. And so now I would like to request CA Hardik Mehta to share the screen and ask, pose the questions to sir.
Yeah.
To you, Hardik.
Yeah. Hi, everyone. Good evening. Just sorry for the disturbance. In the meantime, Manish ma'am, can you, is it possible for you to share? I'm just trying it. I guess there is some issue in the sharing.
Manisha, do you want me to share?
Yeah, Soumya bhai, it will be good if you can if you could share for some time. I can resolve the issue in 5
Sure.
minutes. Yeah, sorry. Thank you.
I think even as you try to resolve the issue, we can, if everybody has a copy of the questionnaire, yes, here it is.
Yeah.
So, sir, the first question is for Shabbir bhai. Hardik, can you just read it out the question for sir?
Hardik?
Hello. Yeah, am I audible?
Yeah, you're audible.
Yeah. Okay. Yeah. Okay. Okay, sir. The first question is regarding remittances through PayPal and transfer wire. So it's a very huge issue. Many of us are getting payment through PayPal actually. So the question is whether remittances received through PayPal and transfer wise can be accepted as a remittance of foreign currency in case of export of services. Will the answer change if a receipt is in relation to FDI investment in Indian company?
So, Shabbir,
So I'll request Shabbir sir to answer this. Shabbir sir. Hello.
So, okay,
guess
am I
he's
audible? I can
audible.
answer the question and we can move on.
Yeah, yeah.
I think so. Yes, sir.
Mohanty sir, you can.
Shabbir bhai, you have the connection? Are you able to hear us?
I guess he's logged out.
Okay. The answer to this question is very simple, is that if it is export of services, up to the limit that this PayPal and TransferWise, they come under two different regimes. PayPal is that, what is it called? That online payment up to $10,000. So, and TransferWise is basically for personal remittances. If you receive payment through PayPal up to 10,000 rupees for export of services, this will be treated as receipt in foreign exchange. But as far as TransferWise is concerned, it is basically for personal remittances and not for business remittances. You see, these people like Western Union and TransferWise were authorized some 3-4 years back to make remittances. But as far as receipt of remittance is concerned, the regulations are not very well formed on, and if you receive any money through TransferWise or Western Union, then this to be treated as realization in foreign currency for export of services, this position is not clear. PayPal, that OPGSP regulation will apply, and up to $10,000 you can receive. The answer will change if it is FDI investment or any other this kind of transaction. This will not be treated as receipt through banking channel, so therefore whatever formalities are required, KYC and other things, that will not be acceptable.
Okay, sir.
I
Great.
guess Shabbir sir has already joined in.
Okay. Should I
Shabbir,
read the question again for you?
Hardik, I guess Shabbir has already joined in, so we can put the question to him too.
Yeah, sure. So I'll just read it again for him. So am I audible, Sabir sir? Hello.
I think
Shabbir,
he
I
has to-
guess you'll have to unmute yourself. No, he's not joined. He's not joined.
Okay.
Shall we wait for a minute or so?
So we'll go to the second.
Yes, as you wish.
Okay, fine. I'll just take the next question. It's for you, Mohanty sir. It's regarding payments.
Yes, I have gone through the question. The question is whether the credit cards can be used for availing various foreign services, and whether it will be legitimate under FEMA. The answer to this is basically what is the service that you are availing. You can very well use the credit card for personal payments, not for corporate payments. For personal payments, you can very well use an international credit card. It can be used for import of goods. It can be used for import of services. It can be used for availing of services like if you are visiting abroad, booking a flight ticket or a railway ticket in that destination country, or hotels, any kind of things, museums, etc. You can use for all of these things. But if you are using it for, let's say, things like buying a lottery ticket, and it has been used in the past for, and it continues to be used for forex trading. So those kinds of things, if you are using for transactions which are not permitted in themselves, if you are using it for transactions which are capital account in nature, so those transactions you cannot use for instance, you cannot use a credit card to buy stocks on New York Stock Exchange. So credit cards can be used for import of goods for personal use, import of services for personal use, for buying services to be used during your visit in those places, hotels and things like that. Does this answer the question? Hello?
Yes.
If there is anything remains unclear, please don't hesitate to ask questions. Please don't hesitate to raise those points if anything remains unclear.
Extremely clear here. It's extremely clear. Right, sir. So I guess, yeah, I think Sabir sir is also here. Hello. Yeah, Sabir sir, you're not able to hear you. I guess you're on mute, I guess.
So you'll have to unmute yourself.
I think he's having some microphone problem. I don't know if somebody can help him. Somebody can talk to him on the phone. I mean, what exact problem he has?
He's sending message to unmute him. Just wait. I can try to do that. Just Okay, I guess he's unmute now. I guess. Yeah, Shabbir sir, can you hear me? Okay, I guess there's some issue. Manish ma'am, do we
Yeah,
continue with the questions?
I can
Hardik,
continue with Mohanty sir, and as soon as Shabbir joins in, we'll pose the same questions to him, and then we are once all those questions are answered, we'll ask both of them to answer all the questions.
Manisha ma'am, I just spoke with Shabbir sir. He said that we can skip to the question number 4 of Mohanty sir. He'll just join in a couple of minutes because there is some issue with his laptop. So he's just joining in again from another PC.
Fine. Then
Okay,
what
no
we'll do is
problem.
we'll continue with the questions with Mohanty sir, and when he joins in, we'll ask him to answer the remaining.
Yes, yes, yes. I can lend him some of my questions also.
so we want both of you to answer all the questions.
Okay, okay, okay.
we want we want to get the best of all the worlds.
No, you see, there will be some questions. You see, that is what when I am nowadays, I talk to these kinds of gatherings. There was a time whenever whatever I said was law. In
Correct.
some gatherings, in AD conferences and other places, there was a question and I gave an answer what was logical. And then when I come back to office, when people tell me, "Arey, आपने तो ऐसा आंसर दे दिया, ये तो हो नहीं सकता है." So then I used to say, "ठीक है, law change कर दो." I have already said this and this appears logical. अगर law में ऐसा नहीं है, तो then change the law. So, but that is not possible now. In this situation, what basically we say is basically an opinion. Now, the ultimate view will be taken by RBI, or if anybody questions RBI, then it will be a court of law. So the view that will ultimately prevail will be that. So some of the questions which are pretty straightforward and simple, the answers are easy. Those are basically yes, no. It can be done, cannot be done. And there is a reference point for that. But there will be some complicated questions where there is no single answer. There is just a view. So my view will be different. Shabbir bhai's view will be different. Somebody else's views will be different. And ultimately it is RBI which will determine. And the view that we express will be based on how RBI has decided in the past.
Sir,
all
I have
bureaucracy
joined.
basically works on
Yeah,
this
I've joined.
line.
Can I take the question 3? I've joined the call back. Am I audible now?
Oh yes.
All right.
Yes, yes, very much, very much.
Okay, thank you.
Yes,
Thank you,
sir.
sir.
Yes,
And sorry, participants, I am having some technical.
No
So
issue, sir. No
I'm
issue.
happy.
Do I read out the question?
No, I think I'll read
sir?
the question. The third question is the write-off of exports proceed. So the question is, in case the overseas subsidiaries becomes insolvent and export proceeds are not realizable, what remedial actions are required to be undertaken and whether penalty can be levied by the RBI. So now what I understand is that there is an Indian party which has set up an overseas subsidiary and it has exported to this overseas subsidiary and it has an export receivable from this overseas subsidiary, which for certain reason, it has incurred losses, it has become insolvent and it will not be able to pay the exports proceed to the Indian party. Now the question is, under FEMA, there is no distinction between exports to overseas subsidiary and exports to third party. So in my view, whatever option is available vis-a-vis third party export in terms of when you don't realize it, vis-a-vis self write-off, vis-a-vis write-off through AD bank, or vis-a-vis write-off through RBI approval, those procedures equally become applicable to the overseas subsidiary. So you write to the RBI if your threshold exceeds 50%, because as per the master circular master direction on export, para C23, there are various limits stipulated for write-off. So 5%, of exports, as stipulated in the master direction, can be written off by the exporters on a self write-off basis with an AD bank intimation. So this limit is vis-a-vis the total export proceed realized during the calendar year preceding the year in which the write-off is being done. And you can write off 10% through the AD bank, and it's a cumulative limit. So you can write off up to 15% without going to the RBI. Because, when an overseas subsidiary becomes insolvent, typically it will undergo liquidation. And a liquidation is akin to disinvestment under the ODI regulation. And your disinvestment may not be under the automatic route if there are export realizable, because one of the conditions of disinvestment is there should not be any dues outstanding from the overseas subsidiary. So according to me, if your overseas subsidiary has become insolvent, then you have to follow the same process. You have to see the quantum of export. You have to see how much percentage it forms part of the total export proceeds realized in the immediate preceding calendar year. Then you can undertake the write-off on self write-off basis or through the AD bank. Or if the percentage threshold is exceeded, you have to go to the RBI and take their approval. According to me, if you have taken all the due steps, then just because the overseas subsidiary has become insolvent or you are not able to realize your export proceeds, that by itself should not subject you to any penalty. But yes, due procedure and process has to be followed. There is another condition of 25% of self write-off that is permissible for listed companies under automatic route and up to 25% for unlisted company with prior RBI approval. In my view, that route is not applicable to export proceed, and I understand that these export proceeds are of goods and therefore they will be reflected in the EDPMS system, and therefore the AD bank should be able to take a call and write it off as per the RBI circular. If the export proceeds are of services and not of goods or computer software which form part of your EDPMS, then there is a little bit of a difference in view within the bankers whether such write-off is within the AD bank power within the permissible percentage or whether such write-off requires an RBI approval. But in such cases, you have to go to the AD bank. If the AD bank agrees to give you the write-off permission, then you can write it off. If he takes the other view that such write-off is not covered, in the export write-off paragraph or conditions, then he will take you to the RBI. But we have to first solve the write-off problem and then only go into liquidation. That's the step that you will need to follow. And if you, as I said, follow all these steps, I've not seen RBI levying any penalty or anything else if your insolvency and loss is bona fide and if the procedure is correctly followed. I hope that answers the question. Happy for Mohanty sir to supplement me.
No,
Yes,
what you have said, it covers it pretty well. Except I would like to add only one dimension to it. That is, when you are writing off an export receivable from a subsidiary, as long as it falls within the the 5% or 10% limit which you can do yourself or with authorized dealer's permission, it is fine. If it goes to the authorities normally look at it with a little suspicion. Look at it with the level of scrutiny for granting approval for write-off of a larger amount of receivable on account of exports will be subject to a stricter scrutiny. Because normally this anything to do with subsidiary, any write-off or other things, write-off kind of things, whether it is export receivable or it is a loan or it is equity, it's anything. So that could also be a way of diversion of funds. So therefore, that is subjected to a little stricter scrutiny. So that is one thing. The other thing about exports that is there in the next question, so I'll answer it there. Export of services.
Yes, sir. Thank you. So, since Shabbir sir has joined, Shabbir sir, can you do you want me to read out the first two questions? We also like to have your thoughts on the same. Hello. Sabir sir?
Yeah, I am there. I am there.
So do I read out the first two questions as well, so that we can just cope up?
No, first question, I believe Mohanty sir would have explained that. I don't know whether we want to deal with it once again. And second questions, I've already heard Mohanty sir. I have nothing to add there,
Perfect, sir. Perfect.
So I think in the interest of time, let's go ahead, because I think these first two questions are pretty
Yes,
simple.
yes.
I don't think I need to supplement anything which sir would have said, and I would thank sir for stepping in while I was.
Some of the questions are complicated and will take time. So let
Yeah,
us.
that's right. So we should proceed.
We would like to have.
And if time permits, we will also take questions which is not listed here. Any of the participant has got any question or any typical problem, they can always pose it to us. Yes.
Right. Great. Okay, so the fourth question is regarding the write-off and
Shabbir,
Manisha, ma'am, yeah, voice is cracking a bit.
Yes. Shall we start with the question number 4?
Yeah.
Yes, it says that the basic question is a very simple question. Can write-off of service receivable, write-back of service payable be done only with prior RBI approval? You see, this receivable and payable are two different things, so we should deal with them differently. As far as service receivable is concerned, unlike export of goods, export of service is not, the regulations are not very codified. If you read those regulations, they say it is export of goods and services, but somewhere it is mentioned goods specifically, somewhere services are mentioned, somewhere services are not mentioned. There is no mention of extension of time for realization of service proceeds. There is no mention of write-off of service proceeds. So all those things are not there. So that is why there is a lot of confusion and difference of opinion among the AD bankers, as Shabbir Bhai was mentioning in the answer to the previous question, whether it is subsidiary or it is a third party. So as far as service receivables are concerned, what should be the protocol? For instance, if you do not receive within 270 days, for instance, if you do not receive at all and it has to be written off. So what is the process that is to be followed? And the problem why RBI is not able to, RBI has been trying for a good 8-10 years to codify the regulations relating to services. But the basic problem is, unlike goods, where you have a declared value, declared and certified value, a value you declare and the customs certify that. In case of services, it is not there. In case of software, the STPI does that. That Softex form, or nowadays whatever declaration we have, IDBMS. So the STPI and the customs authorities are basically certifying the value that yes, this is the value of the exports, $100, and that is what the exporter has to realize. In case of export of services, nothing like that is there. It's just an invoice, and you receive payment on the basis of invoice. In some cases, the transfer pricing authorities, if it is a related party transaction, then they come into play and that is again is a floor that you have to have a certain minimum percentage of markup. My advice to all the exporters of services is that you follow the same principle that you follow in case of export of goods. Of course, if your authorized dealer says, no, we will have a different regime, then they are free to have it. But if the authorized dealer knowingly takes a decision that, yes, this can be written off, and let us say the service amount, the service realized service proceeds, export of service proceeds is not falling within that 5%, 10% limit, and the authorized dealer, instead of referring to RBI, allows write-off itself, then it is all right, because they have delegated power under section 10 to 12 of FEMA. But my suggestion always would be that you follow the same regulation as is applicable in case of export of goods, both for the time period, the time frame for the realization of exports, as well as for any write-off, any discount to be given, any reduction in invoice value, and so on and so forth. So this is as far as the receivable is concerned. Anything you have to add, Shabbir Bhai?
Sir, just one small point I want to add, that now in the revised FEMA 23R, there is a time period for realization of services also. So goods,
Yes, yes.
software and services have been bought on par. And
Yes.
I, sir, completely agree with you. I mean, we have always taken a view that what applies to goods should also apply for services. But then there have been few instances where some of the banks have got some contrary view. And sometimes we have seen some of the RBI officers have also supported those banks that these cases are not covered. So we had a little bit of flip-flop in the past on these aspects. But I completely agree with you that there is no point in excluding services from the kind of relaxation that are given for goods. And if you see the write-off condition for goods, some of the conditions that they have specified is that, you know, there has to be an issue on quality, you know, the other person should be on under liquidation. There are so many other conditions that they specify. And, you know, it is not only the percentage, but there are all the other conditions that they have specified along with that. So if those conditions are satisfied, then indeed it is a bona fide transaction. And even we've seen that whenever the regulator is asked a question in that context, they've always acceded to. And if the banker is comfortable, seldom we have seen that RBI take a contrary view, but where the banker is not comfortable, the RBI then would not like to, you know, direct accordingly. It would then want to see the case and approve accordingly. So I think one will have to take a case by case call depending on the amount involved, what is the nature of exports, why it is being written off. And if the banker is comfortable, yes, certainly you can proceed. If the banker is not comfortable or takes a view that it does not fall within their delegated power, then the better view is you go to the RBI and take an approval.
You see, and another advice that normally on the basis of what I am seeing from this side of the fence, that is when I was in RBI, it was a different story. And what I see from here, that often two things are problematic. First thing is that in these write-off cases or in any such adjustment of value cases, documentation is very poor. Second thing is that people do not take action in time. I mean, you wake up after 3 years or 4 years that this amount has been outstanding for so long, there is no chance of realization now, so let's go for write-off. So these two things often make it difficult sorry, either for the authorized dealer bank to deal with it or even for RBI to give the approval. So always have it properly documented and go to, and if you take a view that you cannot realize or whatever, and then you approach the bank or RBI in time. Okay, the second part of the question again is a little, people have different views. Write back of service payable, any write back of any payable. I mean, it could be an ECB, it could be any interest payment on ECB, it could be payable on account of imports, it could be payable on account of import of services or goods. See, if you are writing it back, then this is treated as an income. You have to treat it as income in your books of accounts and you have to render it for tax, right? Now, if it is an income, then it's a current account transaction. And if it is a current account transaction, then there is no restriction on it. Because what is the provision of section 5 of FEMA? All current account transactions are permissible unless they are restricted. So if it is an income, then it's a current account transaction and there is no need for any RBI approval. RBI had given in writing in 1 or 2 cases during my time when this thing was posed that this must be, you can do this provided 2 conditions are satisfied. First thing is that the other party, you are writing back liability, and the party who has the claim, the other side of the transaction, he must give an unconditional concurrence for the write-off. That this write-off should not be subject to any condition. This is completely unconditional, unconditional concurrence of the other party for the write-off. And second thing is that this should be treated as income and all the other formalities should be completed. So RBI has given written approval or whatever clarification to a few parties. But off and on, I hear that for this kind of write back, you need RBI permission. Some authorized dealer banks also take that view. And I am aware of one or two cases where such people have gone to RBI and RBI has given a permission that yes, we have no objection to your write back. So this is where it is technically and legally. If you write back without RBI's permission, you will not be committing any breach of any law. But as far as practice is concerned and your dealings with authorized dealer is concerned, sometimes you go to RBI, it only means that some more time. RBI cannot decline this permission provided these two conditions are satisfied, that there is an unconditional concurrence for the write back by you and you are rendering it for income, as income. So it only some time element will be involved. So you will have to deal with it depending upon how you are located and what view your authorized dealer has and whether you have to go to authorized dealer at all. So these are things that you have to consider. Legally and technically, a write back of payable subject to these conditions does not require anybody's approval.
Yeah, Mohanty sir, Shabbir here. I agree with you, sir, because import is a current account transaction, and if you decide not to pay, the country is actually better off from foreign exchange transaction. Traditionally, RBI has been more concerned as to what is the bona fide reason of the write back. Why would somebody not ask money from you? Is there something more than what meets the eye? And most of the bankers would agree that this does not need an approval. They may even give you a clarification. But some of the bankers are taking a view. And here, just one point I want to add, Mohanty sir, that for import of goods, because they get reflected in IDPMS, I believe in the past, when you tried to write off the import payables, it was not enabled in the system. So many times the banker approached the RBI, explaining the facts and asking for that payable to be written off from IDPMS, especially for import of goods and software and stuff like that, which typically have to be reflected in the IDPMS. I believe that facility has now been enabled. So as EDPMS and IDPMS have progressed technically, this facility has been enabled, and I think where the banker is able to write it off, the import of goods payable in the IDPMS, there may not be a need for the AD bank to take a view that it needs an RBI approval, because it's more clear that even the system enables that.
Yes, you are right. I am told that it has been enabled now.
Yes, sir.
But you will come across many such cases, and I do come across. I am sure you would be coming across many such cases where the import outstanding pertains to a period dating back before IDBMS, and they don't even have bill of entry.
Correct.
So
Absolutely right.
In absence of documentation, it becomes a challenge.
Correct. Absolutely right. And the view is that if there is a long aging current account payable, then it may become a capital payable. It may take the color of a loan. That's where matter may get a little more complex. But I think in general, if it's a simple, plain vanilla, a regular import, you don't wanting to pay for certain valid commercial reasons, there is absolutely no need to take any approval from RBI. Just inform the AD bank and we can go ahead.
Okay. So now we come to question number 5. The question is about basically about China, right?
Correct.
So we go to question number 5. Hardik?
Right, sir. Hello.
Anything else on question number 4? Otherwise, we'll move to question number 5.
Right. We can move forward. We can take questions which the participants may write in the chat box at the end.
Very good.
We can take this question, right?
Yes.
So may I read this? We can take this A, B, and C. The different questions. We can take them.
What is this MTT payable? Somebody has asked a question. What is the MTT payable?
I think money transfer. I think
merchanting
trade transaction.
No, merchanting trade.
Yeah, okay.
Merchanting trade will be a little more complicated because you have received the payment. There are two legs. You have received the payment leg, and if you have received the payment leg, then the export leg, then the import leg is supposed to be self-liquidating. You are supposed to apply those proceeds to the payment leg. So why will you not apply that to the payment leg? Why will you eat up all the money and write back the import payables? So that is a complicated issue. See, the write back is basically because of financial difficulty. That is again one thing I forgot to tell you. This write back is because you don't have money to pay. So that is again another thing. If you go to RBI for permission, then this is again another aspect that you will have to show this, that you don't have money to pay, or if you are trying to make a payment after 5 years, then you have to show that you at the appropriate time you did not have money to pay. But in a merchanting trade, so that becomes complicated, that if you have received the payment, then why is it that you are not making payment, and why is it that you are writing back? If you have a satisfactory answer, then it can be considered. Otherwise, I think that will be a problem.
Yeah, I agree with you, sir. Sorry.
Okay. Now, as far as question number 5 is concerned, this 5 is basically the transaction with citizens of China or companies incorporated in China. So this is basically where the ultimate beneficiary of the transaction, is with the is either a person of Chinese citizenship, or it is a company incorporated in China. Okay. Now, in this background, let us go through the questions or whatever cases that you have cited. NRI from China investing in Indian company under Schedule 4 of NDI rules. There is no problem in this. The Press Note 3 provisions will not apply here, because the person is an Indian citizen. Even if he is an NRI, he is an Indian citizen. Right, Shabbir bhai?
Yes, sir, that is correct. But unfortunately, some of the AD banks are not agreeing to this. So if you are investing under Schedule 4, absolutely correct. If it is on non-repatriation basis.
If you are an Indian citizen, if you are an OCI, then the situation will change. But if you are an NRI, that is, if you are a non-resident Indian, I mean, even OCIs and companies controlled by OCIs are covered under Schedule 4. But if that company is in China, company controlled by NRIs or OCIs is in China, or if the OCI is a Chinese citizen, then you cannot do that. But if you are an NRI, that is Indian citizen residing in China temporarily, which would include your Indian ambassador in China, I don't think those kinds of people should have any problem in investing under Schedule 4 on non-repatriation basis.
Absolutely agree, sir. Absolutely agree. I think on non-repatriation basis, I don't see a problem, but there have been recent cases where they've used the word location to apply even to an individual. So if an individual, even if he's an Indian,
no, if he is an OCI, see, if he is an OCI,
if he is an OCI, then that means he is a Chinese citizen.
If he's a Hong Kong citizen, for instance, Hong Kong resident and Hong Kong citizen, but of Indian origin, then he cannot have that freedom under regulation.
No, correct. No, but sir, I am actually facing a live case where the AD bank seems to convey that he has spoken to the RBI. So this is a case of an Indian citizen, Indian passport holder, residing in Hong Kong for last 2 decades, wanting to subscribe to shares under automatic route Schedule 1, sending money, and the bank has returned the money saying this needs government approval. And they are not willing right now to at least accede to that request. So we are trying to convince them that location tax is vis-a-vis the entity. It does not apply to an individual. Only the citizenship tax is applicable to the individual. But somehow I know a couple of AD banks who are not agreeing to this, which is technically not the correct view. But unless the RBI or the government clarifies that, we know that in the market there is an unclarity on this topic at this stage, sir.
Yes. Yes, you see, nowadays it has been about almost 2 years now. No clarity is coming. The government is thinking many things. Several times I have spoken to the Ministry of Finance and to the Niti Aayog and DPIIT. They are thinking sometimes that 10% limit we will put in and all those kinds of things. But nothing is coming. And I myself personally do not know. I am told that 4 or 5 approvals have been given by the government, but I do not know of a single case, directly. Some approvals people say government has given, but I don't know a single case myself.
Yeah, that is correct. That is correct. Even few cases very recently, sir, they have been approved. And these are, I think, augmentation of foreign FDI in an existing company by where the ultimate parent is not Chinese. I mean, I've been told that only some very few cases have got approved, but none of the other cases have been approved by the government as of now, the way we also know at this stage.
Right. We'll come to that question. There is something. The second case is investor from China investing in FPI, which invests in Indian capital market. See, FPIs have been kept out of the ambit of this Chinese restriction. If you have a qualified depository participant registration, even with Chinese owners, even with Chinese investment, you are not prohibited from investing in Indian capital markets. For investing in units of AIF, it can either be FDI or it can be FPI. You see, if you are coming through the FPI route, then I don't think there is any problem as long as you are enjoying a valid QDP registration. But if you are making a FDI in AIF and you are from China or ultimate beneficial interest resides in China, then you cannot do that. So FDI is no. You see, basically the issue here is that we will not give control of any of Indian companies to Chinese investors. So that is the basic purpose. But somehow other in government, the Chinese investors making money out of Indian company also they are, that is not the intention. In that press note, it is if you read it carefully, it is about control. But somehow other they making investment and earning a huge return, that is also something the government is not comfortable with. But technically there is no problem as far as FPI route is concerned. Now the next question is, in a multi-layered structure, until what level Indian company? Yes, anything?
No, sorry, sir.
So in case of a multi-layered structure, until what level Indian company has to check for the above condition? The investor is a listed company in Singapore, which has 1,000+ investors. Does it need to check the restriction for each investor in Singapore public company? This is something which normally should not be a problem. If it is not from Hong Kong or from China, if it is a company which is incorporated in Singapore or in US, you take for instance Google. Do you mean to say Google does not have any Chinese investors? Google is a listed company. Do you mean to say there are no Chinese investors in that? Or you take Amazon, for instance. Do you mean to say that there are no Chinese investors? You take any of these multinational companies. You take BMW. Can you think of any multinational company now, a listed company in which there will be no Chinese investors? So therefore, if the company is incorporated outside China, Hong Kong, Macau, etc., it is a listed company, then there should not be any problem. Now, as far as this level is concerned, you have to see the ultimate beneficial interest. In a listed company, you have to see promoters. You see, for instance, it could be a listed company in Shanghai, but some Chinese state agency owns 52% of the fixed stock. The floating stock is held by all kinds of people. So in those kinds of company, if it is a company which is listed in Singapore, but the promoters share, some Chinese company holds 50% stake in that company, then that company will not be eligible. So you have to see it in that way. If the investors are basically kind of portfolio investors, retail investors, then their nationality and other things cannot be checked, and it is not intention to check either. But as far as large shareholders are concerned, you must always be careful if there is any Chinese ownership. Up to what level? See, I remember a case which was dealt with by the government, and it was at that time the Chinese restriction was not there. It is a very well-known family who have some educational institutions in Bombay. They are based out of Hong Kong. So they were investing through a complicated structure which went to many jurisdictions, and there were several layers. And government went on asking who owns this, who owns that, who owns this, and so on and so forth. At some point of time, they got fed up and said that we will not give you any further information. The government simply rejected the application. So therefore, you have to see the ultimate beneficial ownership. If there are 10 layers and the last layer, the ultimate ownership is in China, you will have to see that. But that is not exactly in case of listed companies, not for these 1,000 retail investors, but for majority investors or for significant investors. Okay, anything you want to add, Shabbir bhai?
No, sir. I think I'm fine. Just one point I wanted to add, that in AIF, there is now a specific schedule under India regulation, Schedule 8. So typically you will invest in the units of AIF under that schedule. And
that is equivalent to FDI.
Yes, that is equivalent to FDI. If it is, it is there, the schedule goes about who's managing the fund, so the investment manager, if it is Indian owned and controlled, then it is treated as, it is not treated as FDI, but if it is not Indian owned and controlled, then it is treated as FDI. So I think in the AIF, the test is vis-a-vis, the
manager, yes.
Manager,
right.
Yeah, the sponsor or manager or the investment manager, they are the ones that have to be looked into. So typically, again, that is under a different schedule. The China restriction, the press note 3, and the amendment which came to NDI rules, that is only for Schedule 1. All other schedules remain unimpacted as of now, because those are all very controlled schedules. There the investor in general will never have a control over the Indian investment, and therefore the government seems to be not worried about them at this stage. Because even under FPI, you can only invest a limited percentage. In aggregate, also they can invest only very limited percentage, unless of course there are some board resolution, or otherwise. So I think it is only under Schedule 1 that this condition applies, and not under any other schedule for AIF or FPI.
You take Schedule 6 for instance, that is FBCI.
Yeah.
Now, if a Chinese entity, if a Chinese company is enjoying, Chinese company or fund or whatever is enjoying FBCI registration, then there is nothing to prohibit it from making payment.
Correct.
Because it is a semi-registered FBCI. So therefore, and similarly, FPI, if it is a QDP registered FPI, then you can't keep them out of the market. So those schedules are all specific. This is basically for pure and simple FDI.
Absolutely right, sir. Absolutely right. I have nothing further to add, sir.
Okay, next. Shall we go to the next?
Yeah.
No, there is no threshold as of now. Some people are taking this view 5% or 10%, but that they are doing that at their risk and cost. If it is even 1% Chinese owned, I'm not talking about the retail investment. If there is even 1% Chinese ownership, if you read the letter of the law, there is no exception. So this 5%, 10% you are reading into the law, which is not there, and this you are doing at your own risk and cost. Question number E, that is case number E. Investment from Hong Kong is investment from China. Investment from Macau is investment from China. But investment from Taiwan is not considered investment from China. Because you see, if you read any of these countries, accession agreement or things like that, they are treated, both China treats them and these countries treat them, these regions treat them, Hong Kong and Macau, as integral part of China. Now, Taiwan is a disputed area. So Taiwan, any investment from Taiwan is not treated as far as India is concerned as, although we don't have diplomatic relationship, but we treated it as separate from China, and Taiwan is not covered. So you can receive any amount of investment from Taiwan without government approval.
Right. And
Question number
as
F.
is, yeah.
Yes.
Share your personal experiences regarding to terms and conditions and sectors in which approval is given by central government with regard to investment from China.
See, I am myself personally not aware of any case, although I have several people have consulted me, but I am not aware of any case which has gone through the central government. But generally, what is the government, in my innumerable discussions with the government, basically what they are trying to, approval that they will give or the exemption that they will give if and whenever it comes. This gentleman who was DPIIT secretary, Mahapatra, he died in COVID last year. So we had come to a very significant extent that, okay, these cases will be given exception. But then somehow this border dispute and other things are not resolving themselves. And all this China matter is now dealt with finality by Ministry of Home Affairs and Ministry of External Affairs. This is not dealt with by the normal people, the Ministry of Finance and Department of Industry, who normally deal with these approvals. Now, what kind of things will go into, will get approved? As Shabbir Bhai was just mentioning, somebody who was augmenting his capital. For instance, you already are invested in India and you want to increase the capital without changing the capital structure. That is, everybody who is stakeholder is bringing in money, or you own 100%, so you are bringing in more money for operation of the company. Expansion of the company, not amounting to any takeover, mind you, not amounting to any takeover or indirect investment. For those kinds of things, they will be inclined. Second thing will be that any industry which is adding to employment. Employment is a very important thing, every day it gets talked about. And any industry which is labor intensive and where employment employment creation is there, so that will also receive priority. The third thing is that non-strategic sectors. For instance, pharma, they are not really very, particularly the retail segment, the formulation segment. Maybe API and generics will be seen differently, but any retail segment, in any other strategic sector, government is not inclined. So basically non-strategic sectors, employment generating sectors, and sectors where you are expanding your activity but not taking over or not making downstream investments or those kinds of things. So these things will be covered, considered positively by the government. Shabbir Bhai, you want to add anything? Some approvals you were mentioning about?
No, I agree with you, sir. I think that's the feel we are also getting, that basically, maybe for a defense or a pharma, a little bit more difficult for a pure Chinese investor. But if your ultimate parent is not China, you have just set up in China, or even your Chinese entity is controlled by people outside China. And here, sir, I just wanted to add this limit of 5% and 10%, because the press note and the amendment to the NDI rule talks about beneficial ownership. People have derived the meaning of beneficial ownership from a couple of regulations. So under the Companies Act and under the PLMA regulation, so properly two thresholds were considered. One was a 10% threshold and one was a 25% threshold. But I think over the period, I think people have now adopted the 10% threshold as the applicable threshold to qualify for beneficial ownership, because most of the AD bank believe if the direct and the indirect ownership of the Chinese entity or individuals, if it is less than 10%, then they are taking a position that the press note and the amendment to NDI is not applicable, and the FDI will be under automatic route. But if you are more than 10%, then a government approval would be required. So I think that's the general view. I don't think that anybody is taking a view that with 1% investment also you need an approval. I have not seen that view being taken. Perhaps to my mind, that's a bit harsh as well.
No,
Because not everyone
see,
is a beneficial owner in a retail kind of an investment scenario. Because typically, say, if the majority is owned by non-Chinese, the Chinese fellow has no say in that process, you know.
you never know. You never know. You see, this is the view that you are taking, but first thing that this is not the position in law. You can't use a definition in Companies Act for solving a FEMA problem, unless FEMA says that we will go by that particular law. For instance, in FEMA, it clearly says that Enforcement Directorate authority will have the same power as mentioned in Section 118 or whatever of Income Tax Act. Or it says that close relations will be as defined in such and such section of Companies Act. So unless that liberty is given to you, you of your own cannot take some definition in Black's Law Dictionary or in some such thing. The courts can do that, not you. You can go and argue to the court that, look, sir, this is what is the situation, but I cannot take that view. So therefore, that 5%, 10%, whoever is doing, as I said, whatever may be the logic of it, because law is not all logic. Law is what is written in the law. Logic we cannot impute on our own unless we have the license from the law itself to do that. So therefore, you are doing it. It may be sensible. It is certainly logical, but then you don't have any authority to do that. So you are doing it at your risk and cost.
No, sir, you're right, sir. Actually, what happened when this, provision?
And this is something which I am saying on the basis of my discussion with the government, some government people at some different points of time.
No, so I'll share you some experience, sir. When this law came in, there was a lot of question that was asked on this point. And what we have seen is when in such cases the FCGPR is filed with a proper disclosure on this, then those FCGPRs are being taken on record by the RBI. So I think what I understand is this position which has been taken on 10% is now with the broad consensus. In fact, it was expected that this position would be clarified by the RBI and the government in due course. But it's been a fairly long time. It has not come in. And I completely agree with you. But at the same time, sir, 10% is a view which popularly the banks and...
No, I don't think RBI is actually accepting this FCGPR. If you disclose that there is Chinese ownership of 7%, RBI is, I don't think RBI will accept that FCGPR. I would like to know the case where they have accepted.
So, sir, we have seen, we've heard about a couple of cases being accepted.
No.
To the banks.
A lot of people are taking those views. A lot of people are taking those views, but as I said, you are taking that at your risk and cost. Maybe that it goes undetected. Okay.
No, sir. Most of the time, the FCGPR or the chartered accountant certificate or the compliance certificate of the company secretary carries that disclosure, because he will also explain on what basis he has construed this provision as applicable or not applicable.
You ask a specific question to the Ministry of Industry or to the RBI that whether a company with 7% ownership, Chinese ownership, will be covered by Press Note 3, and see what reply you get, if you get at all.
Okay. No, I think the government is also shying away from.
Nobody is giving any answer. So therefore,
nobody is giving any answer.
If you of your own, if you take that view, then you are taking it at your risk and cost.
Fair point. So I think, sir, we would go with your wisdom much more than my view. But I'm just trying to express what we've gathered.
No, I'm telling you the logic. I'm telling you the reason.
No, I agree with you, sir. But just so that the participant may know, because I've seen many cases with 10%. In fact, earlier people have filed with 25% also. But somewhere then they've got stuck. So 10% I believe have gone through. 25% is a little higher threshold, unbelievable.
You see the other definition. In FDI definition, they say this 10% limit applies only to listed companies.
Yeah.
Unlisted company, if you invest $1 in an unlisted company, it is FDI, right? Now they are transplanting the same definition to ODI also. Your new ODI regulation, which is pending government.
Yeah. Portfolio and non-portfolio, 10% limit. Yes, sir.
Yes. So if a company buys one share in an Indian company, okay, so in an unlisted company, then that is FDI. And it has to go through it is illogical. Somebody is buying a 1% stake in an Indian company, or somebody is buying a 1% stake in a foreign company through that LRS route or whatever. Why should it be FDI? What kind of control he has? And your FDI is defined in the FDI policy as long-term engagement with management control. What kind of control can you have with 1%? So the 10% basically comes because you start having various kinds of control after 10%, some in 10%, some 25%. You remember you have prepared a chart what the, when I was in RBI, I had requested Hitesh Bhai to have a chart prepared that how the companies act 20%, 25%, I mean 10%, 25%, 51%, 75%. I mean how the control changes.
Correct.
So there are many illogical things, but unfortunately that is the law. What do you do?
Right.
Okay.
Sir.
So the next question is ECB and trade credit. Yes. If you are ECB, the only requirement is that you should be in a non-FATF jurisdiction. No problems. And similarly, trade credit. Yes. If trade is going on and they keep on every day in the paper, I see $130 billion of imports we have from China. So if you are having trade, then trade credit also is okay. So ECB and trade credit you can take provided other conditions are satisfied. It is only FDI which is restricted.
The next one is also regarding that. Can ECB in the form of optionally convertible instruments from such investors be taken?
Optionally convertible instruments will be a little more not very straightforward. Technically, yes, because the RBI circular, that 2007 circular says that this will be treated as ECB. So to the extent that it is treated as ECB, it is perfectly fine. But you remember there is that optionality clause for convertibility. There was one particular case, let me tell you, it was a telecom sector company. The limit of foreign investment was 74% at that point of time. So what is, and this was going on increasing. It was 49 originally, 74, just like your insurance sector, 26, 49, tomorrow it will be 74 and so on and so forth. So what they did, they invested in 10-year optionally convertible debentures. Okay, so at that point of time, it was not treated as FDI. So the moment it became 74%, they converted it. So government took a view, and I was in RBI at that point of time. I also concurred that then they should be compounded from the date that they invested in optionally convertible debentures. Because that was a very wise stratagem, because you can't invest in CCDs. So you are investing in OCDs with full intention to convert it when the limit is opened up. So therefore, OCD, I will be a little, although technically it is ECB and technically it can be done, but I will be a little hesitant in accepting OCDs. If you want a loan, then you take a loan. Don't take an optionally convertible debenture.
Great, sir. Thank you.
Okay. Anything else? Question number 5.
Yeah.
We are running out of time, so I think there are 20 questions or so. So
sir, anything you want to add on this, sir? Sir? Also.
No, I think I'm fine. I hear what Mohanty sir has said. I think it is always better to be careful, because generally, if you have to avail a loan in ECB, why would you go in for an optionally convertible instrument? Typically, avoid as less controversies as possible. So I think if it is an optionally convertible instrument, I would do a little bit more homework with the regulator to try and check if their view would change. Because in ECB, typically what happens is you obtain an LRN number. So if you file for the LRN, if you get the LRN, can you say that that has been accepted? That's a question that I would probably pose to Mohanty sir, because it's always a pre-registration and there is some level of scrutiny at the pre-registration stage. So while of course the registration comes with a caveat that it does not certify that the ECB is in compliance with the regulation. But at the same time, yes, there is with whatever RBI department that issues the LRN does some sanity check in terms of all the terms and conditions to the extent possible. Many cases they have.
I don't think RBI is issuing any LRN for OCDs, optionally convertible debentures.
No, if you avail ECB in the form of say a redeemable preference shares or with some possibly you will be there. If you are going under the FPI route, then that's a separate issue, because otherwise you can't
Separate
issue.
issue, but if you are going to take it as a loan through some of these instruments like OCDs or NCDs or NCDs is a pure loan, so there is no question of any.
That will have to come through the FDA.
But if you are going to invest
FDI,
through OCD or OCPS, it is better that you get RBI clearance. You at least file an LRN and get a registration for loan.
Correct.
Right.
So nothing further to add, Hardik.
Okay. Yeah.
We can proceed. Yeah.
So, next question is regarding borrowing and lending in INR.
See,
So,
as far as
the
this
question-
question is concerned, there were some terms and conditions specified by RBI. I mean, in the good old days, it was there. I don't know whether it is. I saw this question. I was a little perplexed that there are no conditions. There was a 7-year condition that it should be at least for 7 years. There should not be any interest payable. So those conditions were there. In nowadays, of course, many of those old circulars or master circulars have become. You remember anything, Shabbir bhai? Otherwise, this question, I think there are some conditions prescribed by RBI. It will be there in one of the old circulars.
Yeah, that's correct. That is correct, sir. So whether up to that 2,50,000 in foreign currency or in rupees. See, earlier there were separate regulations for borrowing in foreign exchange, borrowing and lending in foreign exchange, and borrowing and lending in rupees. So FEMA 3 and FEMA 4. I think later on the RBI came up with a common notification 3R, so borrowing and lending regulation, in which they have given conditions for such borrowings, but they've said subject to such terms and conditions as the RBI may specify from time to time, but they have not.
These conditions were there in an old circular.
They are there in the old circular. I'm coming to that, sir. So one school of thought is that those conditions are the ones which continue even under FEMA 3R, and so long as you satisfy those conditions, you should be able to do the transaction. But there is another school of thought that circular was issued under the old notifications, and in absence of any guidance under the current notification, if you undertake a transaction, then it would need an RBI approval because no such terms and conditions are specified. Now,
okay.
So that is the view people are taking. In fact, some people have taken a view that if you satisfy those old conditions, you can even do it under the current regulation. So that's how people have proceeded. So both the views are prevalent. I would
no.
In
fact, you see, I don't know. I mean, this is I am coming across this for the first time. Nobody had posed this problem to me. I'll try to have this addressed by RBI. And in any case, if it had come to my notice when I was in RBI, it would have taken me 2 days to issue the necessary instructions.
Clarification. Correct.
But abhi bhi kar lenge. That's not a problem. Don't worry. This thing, somebody please follow up with me. We will have this addressed.
Perfect. No, I think, sir, this has been, represented also to the RBI in the past. I remember BCA and couple of people have invited attention to RBI. And I think, it is better if RBI clarifies this for the benefit of everybody.
We'll have it done.
I think, sir, when this FEMA 3 and 4 were fused, I don't think any new provisions were enacted. It was just a more consolidation of the two. So we believe those conditions should continue, and I think it's just a matter of time that RBI should clarify this.
Yes. You see, the legal position is like this. Unless you will notice that in some of these master directions or the circulars, they say either this particular circular of 2005 has been subsumed in this, or they say that this is overruled by this. Now, if it is not overruled, then after all, it is an APDIR circular issued by RBI. So that continues. That has still the force of law. So that should not be a problem, but we will have it addressed. And for your information, there are many transactions. Now, RBI does not have very detailed guideline about current account transactions, non-trade current account transactions. There is something, but no. For instance, how does a shipping line or a shipping line agent deal with its business? All those foreign currency accounts, collection of money, remittances, and so on and so forth. In the good old days, there used to be SPM, according to which all these airline companies and shipping companies used to do. And you will be surprised to know that whatever was written in that old exchange control manual, if anybody has seen those, not this taxman's manual. There used to be, RBI used to publish section control manuals at one point of time. I think the last was published in 1997. So in that there was an SPM, which detailed how exactly a shipping line or an airline or their agent should operate. The banks are still following that because there is nothing else codified anywhere. So anyway, we will have this issue addressed. We can move to the next question.
Yeah, so I think
We can
sir,
move
the
to,
next question is for me.
Yeah, the question number
Yeah.
7.
Yeah, can you just scroll down? So yes, that's fine. So
Yeah,
I'll read
yes.
question 7. Question 7, Hardik.
Yeah. ECB
So,
for general
yeah,
corporate
the question.
purpose.
See, I think this question talks about, for the purpose of ECB, the distinction between working capital and general corporate purposes. So I think there is, of course, no guidance available, under the law, but I think under the current regulation, if I remember correctly, both the borrowing for working capital and general corporate purposes are now subject to the same minimum average maturity period. So by and large, that distinction is not very relevant, but working capital is something which is connected with your trading or manufacturing activities. So for example, you purchase some goods and which you sell. So what you have to pay to the creditor is a part of your working capital, and what you have to receive from your customer is part of your working capital. But a general corporate purposes in my means when you borrow, you are not clear. So it could be not necessarily working capital. It could be something like advertisement. It could be something like brand building. It could be something like some repairs, which are not necessarily capex. It could be n number of things, which are not necessarily part of your business cycle. So typically what happens is whenever a businessman does a manufacturing, trading, or a service activity, he has a cycle. He incurs regular expenses and he has a regular receivable from his clients. The difference is the working capital which is required to be funded. And in good old days, when we were in 11th and 12th standard, we learned about working capital accounting and elements of working capital. So typically, in absence of any other guidance in the regulation, I would be guided with that anything which has to do with my core purchase, sale, or income generating or expense directly related to the income generating activity, those would be my working capital. So all your payables to your employees, all your rents, or your creditors payment, these would be typically working capital. Whereas general corporate would be other than capital expenditure, because capital expenditure is separately specified. So this could be anything which you may have to do out of the turn. Like for example, as I said, you want to advertise and you have to have a huge advertising expense. You want to build your brand. So you are giving some other marketing spends. You are giving free samples. You are organizing seminars to create awareness for your products. You are doing a lot more other things which are for the larger business purposes and which not necessarily directly result in revenue. Maybe we can classify that as a general corporate purposes. But as I said, by and large now, since the period for both is very similar, the minimum average maturity period, by and large that distinction is not that very relevant. Now the question is, can capital asset be purchased out of general purpose? Now this is, I think, also relevant, I think, in one of the next question that has been posed to me, where I think question number 8, there is some mistake, where ECB was borrowed for capital purposes and it was used for working capital purpose. It's the other way around. So I think in my view, if you have borrowed for general corporate purposes, which is a longer period, and if you use it for capex, for which you could have borrowed for a shorter period, then by and large the regulator should not have any objections to it. I think while I have also not come across this practically, we have always separated funding for capex and funding for general corporate and working capital separately. You can always take 2 ECBs. There is no need to take 1 ECB and use it for both the purposes. So practically the advice is that if you require some funds for capex and some fund for working capital, then nothing stops you from taking 2 ECB at the same time. You take 2 registration, 2 disbursement and use it for 2 separate purposes. Life is very easy. But nonetheless, if you have borrowed for general corporate purposes and if you use it for capex, which is also a permissible purpose, then by and large that shouldn't be a problem, because for general corporate purposes, your minimum average maturity is anyway longer. So you're complying with the law without actually violating the law. But if you have borrowed, as has been mentioned in the question number 8, for capital purposes, and you use it for working capital purposes, then it is certainly a non-compliance or contravention of the law, because that is not permissible. And if you do that, then you will have to go to the RBI, reset your minimum average maturity period perhaps for the entire loan, because now since you have used part of the money for working capital or general corporate purposes, you cannot have half minimum maturity as capex and half minimum average maturity as working capital. So in my view, perhaps the entire minimum average maturity of the loan in such cases has to be reset as per working capital. The interim use of the capex ECB for working capital could be construed as a contravention. It could be subject to compounding, and one will have to regularize the same accordingly by making an application to the RBI, because according to me, this kind of a change in purpose doesn't fall within the AD bank. AD bank is allowed to change the purpose of the whole loan, but I don't think the part of the ECB purpose can be changed. To my mind, that is not permissible. And again, practically, I have not come across anybody doing anything in such way. I'll just pause here. Mohanty sir, do you want to add anything? There are some other links in the question 8, which I will come to in a while.
See, basically, general corporate purpose and working capital, they have these terms have come into the regulation at different points of time. But generally, general corporate purpose is a wider term than working capital. General corporate purpose is any purpose for which a corporate spends money. Okay. Now, it could even be granting an endowment to an university. It could even be spending money on corporate social responsibility. So anything that a corporate is required to spend money as far in compliance with the laws of the land is a general corporate purpose. And my view will be that it also will include capex, and so you have brought borrowed money for general corporate purpose and you have used it for capex. I don't think there will be any problem, because the permissibility of capex is much broader than permissibility for general corporate purposes. Now, working capital is a very well-defined term. It is normally these banks, at one point of time, there used to be those maximum permissible bank finance. That was basically working capital cycle and how much money can the banks put into a company. So in RBI's mind, working capital is very well defined. General corporate purpose is broader. If you have brought money for working capital, but you use it for capex, I don't think there will be any problem. Because the money that you have borrowed, you would have been eligible to borrow for capex also. It is possible that you can borrow for capex, but not for working capital. But whenever you are eligible to borrow for working capital, the same money can be used for capex also. But the second part of the question, if you have borrowed for capex and you have used the money for working capital, then that will be a bit of a problem, because what has to be seen at that point of time is that whether you are eligible to borrow money for working capital. If you are eligible, then there will not be a problem. The simple problem will be RBI will say that, why didn't you tell us? And they may compound you for that. So therefore, as Shabbir bhai said, that if you have borrowed money for capex, and that is what you have indicated in your LRN or in your ECB2 return, etc., but you are using it for working capital, it is better to keep RBI informed and get their specific permission. I don't think the AD will do this, but you can take it from the RBI.
Yes, absolutely agree, sir. I think you can also borrow the working capital definition from the banking parlance, where it is defined in terms of the way a working capital is funded by a bank. That's also a valid way of looking at it. Now, just to go to the additional point in question number 8 very quickly, should the CACS report the same? According to me, he can't report in ECB2 unless it is regularized by the RBI, and the whole purpose is changed to working capital, and the MAM is also reset. So there cannot be any such interim certification by the CACS in the ECB2 if such an event has happened. And if for any reason the CACS has wrongly reported, now again, I don't want to comment over here as to why would a CACS wrongly report the same in ECB2, then what action can RBI take? Well, I mean, just to answer this question from an academic perspective, the RBI proceeds on contravention only against the company and its directors. There is no provision under FEMA to go after any other person, such as a chartered accountant or a consultant. In income tax, we do have a specific provision. If the chartered accountant makes a mistake or gives a wrong certificate, then there is a penalty. But under FEMA, there are no equivalent provision. In most such cases, maybe not with RBI, but couple of other authorities we have seen, in the event of a wrong certification, they generally write to the institute, and the institute takes it up as a case of misconduct. And the institute may, if he found the chartered accountant guilty, depending on the underlying work that he has done, they may monetarily penalize him or suspend his name from practice for a specified period. And we have some example of various authorities' complaint being entertained on a similar basis by the Institute of Chartered Accountants. So I think that's on question.
Thank you.
Mohanty sir, you may add
Just take
real life case.
okay.
Otherwise, we can go to the next question.
Yeah, if you want to answer the second part of this question, if you can do that, or we can go to question 9.
I've already answered, Hardik, the second part.
Okay. Okay.
Yeah,
Okay,
because I've
okay.
said no that the
Okay.
RBI.
I thought you were reading. Okay.
Yeah.
Okay. Okay. I just thought you were saying.
Yeah, because in the interest of time, I'm assuming that the participants have read, because otherwise time will be lost in reading the question.
Correct. Got your point. I thought you were.
No, I'm not reading the question.
Okay.
Because we just have
Okay.
about 25 minutes left, and we are not even halfway.
9 is regarding the round tripping. Okay, so it's I just read it. Mr. is a citizen and resident of India and owns an Indian company, ABC Cart Limited. ABC Cart Limited receives FDI from foreign investors. Subsequently, due to business opportunities outside India, Mr. A want to incorporate a holding company, new holding company in Singapore, which will then operate ABC Cart Limited.
Okay, so this is something which again is a very common thing. A lot of people are doing this. There is an individual who owns a company in India, and then subsequently you are flipping the structure. This individual will set up a company in Singapore, and Singapore will hold the Indian company, and all the shareholders in the Indian company will get shares in the Singapore company. So this is basically the problem. Now this is doable, except that the individual has to corporatize himself. An individual is not allowed to hold shares in a foreign company which has a downstream investment in India or anywhere in the world. This is there in the existing regulation, and this will be there in the coming regulations also. In the coming regulations, this kind of a structure, that is an Indian entity holding a foreign company which invests back into India, is going to be put under automatic rule. But the entity which holds shares in the foreign company has to be a corporate. I mean, has to be eligible to make ODI other than an individual. So it can be a company, it can be an LLP, it can even be a registered partnership firm. So that has to be done. And once that is done, then this flipping the structure will be possible. And then there will be different kind of investors in the Indian company. There could be an NBFC, there could be a AIF, there could be a trust. So you will have to see the permissibility of those entities to hold shares in an overseas company. So that aspect will also have to be done. But in a plain vanilla structure, while there is an Indian corporate which is owning another entity, and now this Indian corporate wants to set up a Singapore company and have a swap of shares, that is doable. Any questions?
No, it's great. We can move to the next one.
Yeah, I think you can go to the next one. I just thought that we have to be very careful that even under the new ODI regulation, the FDI below ODI is subject to the condition that there is no tax planning or tax evasion. So therefore, we are trying to set up a structure where Indian resident own a Singapore company and the Singapore company owns the Indian company. The question is whether that case would be treated by the tax authorities as a case of tax evasion or tax avoidance. And if it is so, then it is not permitted even under the proposed regulation. Under the current regulation, under the RBI FAQ, there is a question number 64, which specifically says that when you set up a JV or a VOS, or when you acquire a JV or a VOS, it cannot have an FDI into an Indian company unless prior approval of the RBI is obtained. So if you were to set up something in the current structure, you will perhaps need a not only corporatization, but a specific approval from RBI. After the new draft ODI guidelines are enacted, this structure can be availed under the automatic route, subject to the condition that there is no tax evasion or tax planning. And there would be, of course, tax consequences of the flip, and Mohanty sir, of course, you can elaborate some of these
not elaborate. I just wanted to make a point that this tax is now the bone of contention. RBI does not want this tax thing in FEMA. RBI at the highest level does not want this tax thing in FEMA. So that is the bone of contention why it is taking so long to come out. The revenue guys want this tax neutrality or whatever, no tax evasion, no tax avoidance condition. But RBI says that you remove this from here. Any structure, you do it separately under income tax law, but don't. How will the FEMA guys? We are not tax experts. How are we going to? How are we going to implement this? So that problem is there. So RBI wants that tax reference to be removed, and government wants that to be there.
Correct. No, absolutely right, sir. I mean, and we have also represented that even if it is tax planning, suppose eventually if tax was demanded and was paid, why should the FEMA structure itself be challenged on that ground? So, at appropriate stage, the taxpayer may want to pay tax. It's not that it is always tax planning. They may take some view, and if the view is not accepted, they would pay the tax. So why should tax be a driver? But nonetheless, that's the current law and the proposed law, and one will have to see how the new draft ODI guidelines are enacted and what conditions are stipulated, vis-a-vis, such structures. And again, various concerns, could arise in terms of what type of funds come back into India and stuff like that, which of course I believe would be fine-tuned in the new guidelines that typically come in. You can go
okay. Shall we expedite it a little more because we have so much and we have to stop at 8 o'clock?
Yeah, sir. We will. I think I'll probably wrap up question 10 very quickly. So I think this question is about, a non-resident relative gifting to an Indian citizen and an Indian resident under FEMA shares of a foreign company which has a subsidiary or a company in India, and whether this gifting, results into round tripping. So I think before we, answer this question, just in terms of the legal framework. So under FEMA 120 regulation 22, and even under the master direction paragraph C1, there is a general permission available to resident individual for receiving gift of foreign securities from person resident outside India. So certainly if this gift is out of natural love and affection, it would be permissible under FEMA. But if it is undertaken not with natural love and affection, it is perhaps undertaken to put in place a structure which otherwise was not directly permissible, then perhaps the regulatory authority may not look upon it so favorably. Now, in this question, fortunately, Mr. B is a close relative. So to that extent, the gift, whether it is bona fide or no, can be more appropriately explained. But I would leave it at that stage because according to me, what is a gift and why there was a gift and why there was a gift at a particular instance and in a particular structure, these are not, easy questions to answer, and it will all depend on case by case as to what view the regulator will take. The next question is, will Mr. B allowed to hold the investment, which in turn holds the Indian company? Now, I think because Mr. A acquires 100% of the shares of the company, and it is not strictly speaking a portfolio investment, and it is strictly speaking not in accordance with the ODI rules for the individual, it would be perhaps more appropriate for Mr. A to intimate the RBI that he has got the gift and he be allowed to continue. Because otherwise what happens is that this structure gets frozen. Because if Mr. A has to invest any fresh money or undertake any other transaction with XYZ, it will not fit in, at least within the framework of the current and the proposed ODI law. So I think one thing that we would typically recommend in such cases is that if something like this happens, it may be more prudent to write to the RBI that this is what has happened, and let them take the structure on record, let them put in some terms and conditions if required, or if they raise some objection, then it is better that it is dealt at the upfront stage itself than after a few years where the regulator or someone else may have some objection to the structure. So I think here again the advice would be that if the gift is construed as bona fide, it is not part of any other step or arrangement, then certainly Mr. A can get that gift. But it would be better if Mr. A intimates to the RBI and puts it on record that this was a bona fide gift, and also simultaneously seek permission to further capitalize this investment, or in respect of even any other transaction, like he may want to do further capital infusion or stuff like that, which will then not fall in line with the ODI framework. So it is better that the Reserve Bank is informed and this structure is put on record, so that any ambiguity surrounding the structure is addressed upfront. So I believe this answers the question number 3 also. I don't think there is a need to address the question number 3, because as I said, perhaps if the gift is bona fide, then certainly doable. The question 64, which applies to Indian party for round tripping for FDI below ODI, should generally not apply to regulation 22 and the gift by a resident individual. But yes, such structures are not easy, should not be followed except for genuine purposes and genuine gift. And even if such structures come into place, it is better to inform RBI and put the structure on the record.
Okay. Now, sir, both of your permission, can we move to the next topic on LRS? Because I guess we can cover that. Many of our participants have issues in that. So if it's okay with both of you.
Yeah, we can go to the LRS.
Yes.
Question 14. That's what you are saying?
Correct.
Yeah, okay, we can go to question 14. Yeah, so I think again, this is a very vexed question, and again, there is no right or wrong answer, and there could be views on both sides. So, we have current account rules, and we have a schedule 1 of the current account rules, where a person resident in India who is an individual can draw up to $250,000 for any of the purposes listed over there, which is limit is a conjoined limit with the LRS investment limits as well. And their immigration is one of the items that has been mentioned in the current account rules. So therefore, if any expenses is incurred under the current account rule for the purpose of immigration, that is necessarily the running expenses to achieve the immigration. There is no capital investment that is specified under the current account rule schedule 1. So therefore, if anybody has to make any investment in any capital instrument, irrespective of the purpose of that capital instrument, he has to go under the FEMA 1 and the permissible investment in shares, units, bonds, and other securities under the LRS guidelines. And under the LRS guidelines, there is one place under the master direction, para 7D, where they've categorically said that the for the purpose of emigration, the remittance can be only allowed toward meeting incidental expenses. And it will not be allowed for earning points or credits to become eligible for immigration by way of overseas investment in government bonds, lands, or commercial enterprise. Therefore, this particular paragraph in the master direction of the LRS guidelines seems to put in a condition that if you were to invest specifically for the purpose of obtaining a visa or obtaining immigration, then perhaps that is not permissible under the regulation. However, at the same time, if there are instruments where you would definitely want to invest for capital purposes, but coincidentally it is that you become also eligible for a visa, then those could arguably be permissible. But when one decides to invest, one has to be careful that this is not an area where there is a clear view available from the regulator. And we have come across AD Bank again, who are willing to make this investment because they said that we are not concerned with EB5. If you make an investment in shares, which is otherwise eligible under LRS, what happens out of that, we are not bothered. They don't go into that type of information. But according to me, if one was to take a little bit of a conservative view and a little bit of a more pragmatic view, then because of the express language, one should not proceed with making such investment without a prior clarification or an approval from the RBI. And I think this is a topic on which perhaps more than me, Mr. Mohanty can throw much more light on that, because I'm sure he would be far more close to this topic than me on the subject. So I would invite him to share his views also on this topic. But according to me, this is a little a debatable proposition because of the caveat that is used in the RBI master direction vis-a-vis the category for emigration, where there is an embargo specifically on making investment in government bonds or other instrument for the purpose of becoming eligible for points or something like that, which could give you a visa, which could facilitate your immigration, sorry, not immigration. So immigration from the overseas country perspective and immigration from India's perspective. So this is my view, and happy, Mohanty sir, for you to sort of supplement.
See, Shabbir bhai, you have covered it well. We must understand one thing. First thing is that it is not the immigration expenses permitted in the Schedule 3 of FEMCAT rules. That is basically the money.
Correct. Sorry, sir. Schedule 3. Correct.
That is basically the money that you are allowed to take when you are immigrating to Canada or anywhere. That is the money that you take to meet your expenses till you find a job there. So that is that kind of money. So that is current account transaction covered in FEMCAT rules. This investment, this amount that we are talking about is not for immigration, because immigration is not guaranteed. This is for visa. So some of the countries, and in fact most of the countries, they say that, okay, you bring in this much amount of money, so we will give you a visa. If you are coming here, then what is it that this country is gaining? So you get some money. For instance, in US, you invest in some community development funds, like they are building some park or some school or some hospital or something the government is building. So you invest in a fund which provides the purpose of that. In US, it is something else. In US, I think it is $500,000. In UK, it is $2 million or something like that. An eminent Supreme Court lawyer once asked me this question: how do I send 2 million pounds? I said, you can send it under LRS. Only thing that you make sure is that when you are sending this money under LRS, see, again, from LRS, when LRS was introduced, the gentleman who used to head FED, I remember, he was basically, once he used this term, that this is your money. You can even take this money in a sack and throw it in the Bay of Bengal or Arabian Sea. So whatever you do, there is no questions asked. But somehow or other, over time, what you are doing with that money and other things, mind you, this can be used for buying a house. Okay. So that is, immovable property is one of the most restricted things. So that is permitted. So therefore, my advice will be, yes, you can send this money within your limit if it is permitted. But just ensure that what is it that you are getting in return. that must be that you should be able to call an investment instrument. If you are able to do that, and as Shabbir bhai rightly said, incidentally, the two things are linked up. I am sending some money, I will get just like the Indians investing in gold bond and getting a 2.5% return. Similarly, you put in money in some community development project where they give you a 3% return or 1% return or whatever. So if you can call it an investment, then it is perfectly all right. And most of the cases, these kinds of investment there. Even if they say that you have to show a bank deposit of $1 million, and if suppose you are eligible to send $1 million, even that is perfectly all right, because bank deposit is also a permitted LRS transaction. So it will depend upon the nature of the remittance that you are making, which will enable you to qualify for visa. So that investment and what is it that you are getting, the units, investment certificates or whatever. So that has to be carefully seen. Shall we go to the next
agree
question?
with you, sir. Yeah, very well said, sir. Yeah, we can move to the next question. Hardik, which one you want to pick up now?
Sir, if you permit, you can take the 15th question. Yes, sir.
You want 15 to be covered?
Yes, sir. I think he's saying 15.
Right, sir. Yes.
Okay. See, now when the new ODI regulations come, that ODI and portfolio, they are making a very clear distinction. So we will not have any problem. But essentially, this board representation, despite, because the control, if you read, for instance, the FDI, FEMA non-debt investment, non-debt instrument rules, or the earlier FEMA 20 or whatever, you see they say that control by any means, ability to appoint majority of directors or by any other means. For instance, when Etihad had invested in Jet, they had a very small percentage of share, but they had control through share purchase agreement. So therefore, if you have a board representation, that is one of the things which RBI says, RBI sees as a case of control. I remember having cleared one case where Indian entity was investing in 2%, and that was made as eligible for ODI because they were getting a board seat, or rather they manipulated it in such a way that they were getting a board seat. They came with that kind of a request to RBI, and we had cleared the case. So therefore, the answer to that will be, if 9% without any board control, if it is there is board control, normally RBI will see it as a foreign investment. You see, LRS you can use both for FDI, I mean ODI, as well as portfolio investment. But what exactly the nature of the investment will be determined by this. Once the new regulations comes, if it is less than 10% in a listed company, whether you have board seat or no board seat, that will be treated as portfolio investment. If you have 1% stake in a unlisted company, whether it is listed, whether you have a board seat or you have no board seat, it will be treated as ODI. So that distinction will be very clear, and this doubt will go away. Now, if you have purchased 25% equity shares without any board representation or control, that will be treated as ODI. As the things are, although there is no clear pointer under the regulations, but RBI will treat this as ODI because 25% is significant shareholding. But these difficulties will go away once the new regulations come.
Yeah, the only Sir Shabbir here, the only one point is that under the new regulation for the portfolio investment, unlisted shares will not be permitted. It has been carved out.
Yes, yes,
So
you are absolutely right.
That is another issue, that unlisted shares will now never be portfolio.
Exactly.
Irrespective of the percentage. But
exactly, that's what they are saying. No, even if you buy one share in an unlisted company, that will be a ODI, no portfolio.
Correct. So that's where the RBI is heading. But
so that is right.
Yeah, I think. See, the question is, it's just not about the percentage, because the regulation uses the word joint venture. And what we have to see is that, what is the relationship otherwise between this individual the majority shareholders and this investee company? Do they have common business interests? Do they have trade with each other? Do they give a know-how? There are many elements which determine that there is a venture just from a board seat. I think those factors would equally be relevant to determine whether it is a portfolio or not a portfolio. And if suppose the board seat is only to protect the investment, even if it's a financial investment, you are just giving a seat so that you just have a veto right to protect your interest. You don't have any other right. I think those are some of the other parameters which may become relevant.
No, see, there are many issues. For instance, affirmative rights as of now, neither by SEBI nor by RBI, affirmative rights are considered as control. There has been several attempts to bring in affirmative rights as an element of control, but somehow that has not happened yet. So therefore, let us not get bogged down by those details. And in fact, this you are mentioning this balance of payment and international IIP manual of IMF and OECD manual, this 10%, that is a big problem which Chidambaram said in the floor of the parliament that we should will align our regulations with that. See, this is a statistical, this guidance is basically statistical guidance. Then they appointed Mayaram committee and Mayaram committee made its recommendations which were implemented, which is creating a lot of problem now because you see something which is basically used for statistical purpose, if you use it for regulatory purpose, then it throws its own problems. But be that as it may, the problem is this, that unlisted company, any investment is ODI or FDI, and listed company only 10% and above is FDI and not less. It is perfectly possible. Those kinds of things may come up, like just like the Etihad Jet, that you have 6% investment, but you have absolute control. In that case, what would you do?
No, agreed, sir. Agreed. Absolutely correct.
Okay, next question. It's already 8 o'clock. So anything else that you want to be?
Correct, sir. If you can cover this a bit quickly, if you want, this part F. If it's okay.
You want to cover the 16 one?
The 16.
Sorry, Hardik, I'm not able to hear you. Hello.
Sorry, am I audible now, sir?
Yeah, you're audible.
Yeah, sir. Okay. So I'm just asking that if this question 16, if you may cover it, we can also get to know regarding this, because we have a few questions regarding this from our participants as well. So we can, if you permit, we can take this quickly.
Yeah, I'll try and take it quickly as possible. So Mr. A is an Indian citizen employed in US and a non-resident in India. He resigned from US and moved to India in 2020 and became a resident in India. He had investment in shares, security, and US company undertaking business, immovable property, as well as bank balance when he moved back to India in 2020. He wishes to reinvest his US earning in US stock market as well as the real estate market.
No, you see, Shabbir bhai, let me answer this question, because this answer to this question is very simple.
Sure, sir.
Once you have 6-4 protection for any money, that is the money that you earned when you were in US. That is the money that you held when you are in US. You can hold, own, transfer, anything that you can do. You can buy, if you had investment in stock, you can sell it, buy bonds, you can buy immovable property, you can keep it as bank deposit, you can float another company in Singapore. You can float even a company in India, except that if you do it in individual capacity, then there will be a problem. But if that money you use to float a company in US, it is perfectly all right. If you float a company in Singapore, that is also perfectly all right. But if you float in India, then that will be a different problem. Now, only thing is that you cannot take a loan leveraging that money. If you have become a resident, then let us say you have a balance of $100,000. You can use that $100,000 to buy a house if you can get a house within that money. But you can't say that I will take a loan, a mortgage of $1 million using that $100,000 as down payment. That is not permitted, because the resident is not allowed to take loan. That is your question number 3. And you are not required to file any APR on anything after returning to India. Okay, shall we move to the next question?
Right,
Yes,
sir.
just one point I would like to add.
Protection, 6.4 protection is all inclusive. And that will overrule any regulation or rules, because it comes out of the act itself and it is not subject to the rules and regulations. So therefore 6.4 is the ultimate protection for anything that you want to do with the money that you earned and had kept when you were a non-resident, or if you inherit from a non-resident, and so on and so forth.
Yeah, that's correct, sir. That is correct. I would agree with you. There is only just one point I want to highlight to the group, that under FEMA 120, there is a regulation 4 and which talks about general permission to the resident to invest from his foreign sources if he is a person resident in India but not permanently resident. So it seems that when you invest in securities, you may have to test that condition of permanently resident or not permanently resident.
No,
But
no,
it's a
no,
very
no.
easy test. Generally, we
No,
will
no,
not come
no,
across
no.
anybody.
No. This does not relate to 6.4. This is basically talking about if John Doe of England takes up a job, who is employed by, let us say, Standard Chartered Bank, comes on deputation to India for 3 years, then he is a person resident who is he is resident but not permanently resident. So basically, it gives exemption to those people that if you are even if you are a resident, you can do anything that you want with your UK money, or the money that you have sent from India, because you are allowed to send your entire salary out net of local expenses and taxes. So with that money, you can do anything. 6.4 will get the same this thing, because that money also, just like this John Doe, he can even when he is coming to India, he can retain his money, his house, his everything, pension benefits, social security, everything. Similarly, a person who comes to India and he becomes a resident in India, the money that he had when he was a non-resident, he enjoys identical freedom. So there is no problem in that. Because it comes out of the act itself.
Yeah, I agree with you, but I think, sir, most of the cases, I mean, while you are absolutely right, and we have also taken a view that 6.4 overrides that regulation 4, but there is a little confusion the way it is worded. So we always have come across a situation where that condition is also very easy to satisfy. I don't think we've come across any condition where the two cannot coexist. And we completely agree that 6.4 would otherwise override because it's a more absolute provision. In fact, there is
only problem will be if you get that money into India, then it loses that character, 6.4 character. Correct. You can't send it out again.
Correct. Absolutely right, sir. So in fact, there is an RBI circular somewhere in 2014. They've come across and they've also said that income on those assets can also be retained and invested outside India, which is over and above the main item, because there was a lot of confusion whether 6.4 covers only the original asset or it also covers the income on those assets. So there is one circular that RBI issued somewhere in 2014, I think circular 20 or something.
Yes, I know.
They have clarified that even the income can be used freely outside India. So I agree with you, sir, but I just thought it is good for the audience to understand some of the nuances and then plan accordingly.
And I always say, if you have such clients, and there are plenty of such clients nowadays, you keep your 6.4 money and LRS money in separate accounts, because 6.4 money is like it enjoys tremendous amount of freedom. LRS money does not enjoy the same freedom. So you don't mingle up your 6.4 money and the money that you might have remitted from India through LRS. And all the money remitted through LRS and assets created through LRS, you keep separate from your 6.4 money and 6.4 assets.
Absolutely right, sir. I think that makes a lot of sense. So in FEMA, basically you keep every transaction independent and separate procedure as possible, whether it is 6.4 LRS, whether it is ECB, general capital, whether it is FDI, FPI. You try and keep everything as much distinct and as much clear and original as possible. Don't try and mix Harbour line and Western line and Central line together. That's not permitted in very simple words.
Right. Next. We should not be overstepping our time too much, because it is evening. People will have other engagements. Next.
I think we can probably
right, sir,
take
right.
one more and then close probably, you know.
Right, sir. Can we take question number 12? It's a small one. Just one, sir. Just, yeah. The 12th one regarding immovable property. We can skip 12, 11 and 13. But just
Answer is
12,
no. You can't buy. You can buy anything, but you cannot buy agricultural land in India and carry out agricultural or plantation activities. It is specifically prohibited.
Yeah, I think yes, that's absolutely correct. Buy is not permitted. Inheritance is covered. Under 6465. Sir, the only
Yes,
question,
yes.
you know, which is the whether the agriculture activity can be carried out under grandfathering provisions of FEMA section 6, you know, because there are again a little bit of different in views that you can acquire the property but you can't carry out agricultural activity. There is some mix up with some other regulations here and there. That is the main I think question, that can you carry out
No,
agricultural activity?
I would be very clear on this point. You cannot acquire any agricultural property. If the revenue classification of the land is agricultural land, a non-resident Indian citizen cannot buy that land.
No, sir, inheritance. I'm talking about inheritance.
Nah, if you
So buying is
inherit,
absolutely rule out. There you can't buy the land. It's very clear under the law.
if you inherit or if you had acquired it when you were a resident, that will get 6(5) protection.
Correct.
But as you said, carrying out agricultural activity, obviously agricultural land there will be agricultural activity. I don't think there will be any problem in that.
Correct. I agree. I agree with you, sir. That there shouldn't be a problem, but there is a little bit of a view that it becomes your proprietary concern and maybe you are prohibited under NRI non-repatriation also some of those activities or whatever. So therefore people are taking a view, but that to my mind is incorrect. If you're allowed to inherit, you should be allowed to enjoy the fruits of the inheritance also. You can't take the usufruct of the inheritance outside the inheritance, and then the purpose is lost of the law, you know, which is to my mind not the right way of looking at things. So I would very much agree that yes, you can't buy, but it is grandfathered if it is inherited or if you are acquired it when it was a resident. And of course, you can continue the activity.
I believe there are some state laws in some of the states that if you don't carry out agriculture on agricultural land, then you will be dispossessed of that land.
Yeah, I mean, if there is a prohibition under the state law, then you will have to see what you want to do. I know Goa or maybe some of those states made some extra possible. We are of course not a real estate expert or expert in agricultural law or land law, but I think in general from a FEMA perspective, we don't see any issue. It may also happen that you may own a land and you can appoint somebody as a custodian to carry out the agriculture activity. Even that is possible, and he or she may pay you some rent or some of the other thing, which is also possible. So I think there are umpteen number of ways in which affairs can be managed depending on the underlying law. But idea of at least the foreign exchange law is not to take the benefit of the fruits away, which is otherwise eligible. I think with that, we should probably, you know,
definitely. All the important questions. Correct. All the important questions of today's brain trust, all the postures, all the questions are definitely and very well and very clearly been explained by both of you. Actually, we are really thankful and grateful on behalf of Ahmedabad branch and all the participants for sharing your time with us and enlighten us on this subject and on topic, and really, because FEMA is a subject where people will need to invest more and more time so to give proper guidance to their clients, and by attending this lecture for 2 hours, many questions have been resolved and many queries are solved. We are really grateful, and I know all of us will agree with us that the guru is always at the greatest place in everyone's life. And then sir, you both of you are a guru of all of us on this subject. So we are really grateful and really thank you, sir, on behalf of each and every one of us to have us with you.
Well, thanks to Mohanty
Thank
sir
you.
also, we've learned so much from him. I have learned most of my FEMA from him also. So I think whatever little I've been explained, that is also thanks to Mohanty sir. And of course, a lot of other people also in RBI who have been very kind to explain some of the intricacies, because as Mohanty sir explained, this is a substantive law, not a literal law. And therefore, you have to look at the substance, look at the intention of the law and then interpret. You can't read the law literally and come to any conclusion. And it's going to evolve continuously over the next. And Mohanty sir, I have always said this, that it's a very simple act, some less than 60 sections, but more than 400 notifications, more than 2,000 circulars possibly, or 1,500 circulars
See,
over the last 20
see.
years. So that's where the challenge is.
See, that is because no matter how much you try, it is a law which is simple to write but very difficult to administer, because law will have to deal with situations which are not predicted anywhere. I'll tell you, let me end on a lighter note. I'll tell you two anecdotes of 80s. One anecdote was that in those days, you cannot buy a single dollar from an authorized dealer without an RBI permit. There was a case where an exporter from Calcutta, that is where I started my career, an exporter from Calcutta had exported some 200 rhesus monkeys to US. Now, when these monkeys landed in US, those days, those animal exports and other things were permitted. So those monkeys, when they landed for various these laboratory tests and other things, they had been exported. And when they landed in US, they were found to be infected. So the US border authorities, the customs authorities, they quarantined them for 3 weeks. And when the monkeys were not okay, when they did not recover, they shot them down. Now, and they sent a bill for the 3 weeks quarantine, the treatment and the shooting charges. Now the exporter came running that instead of realizing the export proceeds, he now has a bill to pay. So how exactly do you deal with this? There is nothing written in the manual. So RBI people started scratching their heads that how exactly do we do this? There was another case where your Institute of Chartered Accountants was holding, I think, their 50th anniversary or something. That must have been in 85 or so. And they had invited the chairman of the UK Institute of Chartered Accountants of UK and Wales. And they had taken RBI's permission to pay the bills of Lord something and his lady. Okay, those days you cannot pay the bills of a non-resident guest, a foreign guest in a hotel bill, in a hotel. He is supposed to pay dollars himself, dollar or sterlings or whatever. You cannot pay. If you want to pay, then you have to take permission from RBI. Now, this gentleman arrived with his wife and also his daughter. Now, the institute people made them sit in the foyer of Grand Hotel in Calcutta and ran to RBI that you give us permission for the third person. Otherwise, how do we, we can't tell them that you pay the bill of the daughter yourself. So in RBI, the regional office was not competent to do this. Only way they could do it is with central office approval. And unfortunately, Bombay was closed that day. So what do you do? So these kinds of things, even today, so these are very simple transactions. But remember, for these things also one required RBI permission and RBI had to grant a permission. But today, similarly, you take ECB, you take ODI, you take FDI, there are always complicated cases. And now another big issue on which I did not see any question is these trusts. There are many rich people with immense wealth in India, but they have their relations, their sons, their children, grandchildren outside India. So they want to create a trust so that the money can be passed on to the NRI relations. So that is again a kind of a problem which is trust is not spoken about in the FEMA regulations at all. So there will always be these interesting things, and that is why I always find interesting that interacting with in these kinds of forums where new kind of problems come up, and the regulator will have to learn to respond to these problems. So that is why these interactions are very useful. And as far as I am concerned, you see, anybody can call me, and if you have an interesting problem or a difficult situation, you can always call me and talk to me.
Sir, one more question
you.
which I was expecting, which has not come, is on cryptocurrency, but we'll leave it for some other time. I think the audience has been very kind, so we'll leave it at that stage.
Today RBI governor said that. Today RBI governor said that the crypto, it doesn't have any underlying, not even tulips. So that is being massacred in the Twitter, in the social media. I was just seeing that observation. So on crypto, the less you say, the better. The less question that you ask or less you say, the better. Because nobody knows how to deal with crypto.
All right. Thank you, sir.
Okay, thank you so much.
Talking to you, Hardik.
We will also like to have both of you again on our forum. And we love to have both of you together again and again on the topic. So we have a few questions also in chat box, but we can do one thing. We can try to mail it to you, and you whenever it's convenient, both of you can give your feedback on those questions. You can do that. So there are a few questions by the participants. So we will end here, sir. Thank you. Thanks a lot. Thank you for sharing your wisdom with us, sir. On behalf of Ahmedabad branch, Chairman Harit Bhai, I like to from bottom of our heart, like to thank you. Thank you, sir.
Thank you, everyone. Thank you so much. Thank you, Mohanty sir. See you. Bye-bye. Take care.
Bye.